Well, good morning. It's kind of weird. We're both at home and I miss my friend and I'm kind of sitting down, which is rare for me too. But you guys are feeling it. It's like -50 out there. Okay, maybe I'm a little extreme, but it was wicked cold. The little dogs started to go out and then they're like, no, 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 paws are too cold. So we're excited to bring you the last market update for the year, for the month, for the year. We're kicking 2022 to the side. We're getting ready and excited about a new year, reset button, new opportunities, and new conversations. So I know Megan's got a ton to share on the real estate side. I've got some things to share that are a little surprising on the economic side. And of course, we're waiting for tomorrow's PCE number. The whole market is like, so we're all waiting for that. But here's my quote. So I have to show you the picture because it really is, the picture is 1,000 words on this one. So I'm going to share my screen, then I'm going to unshare it, and then we're going to turn it over to Megan. So here we go. So this is, can you see it? Never look at the wall. Look at the wall. So you guys know I've been doing a ton around vision casting for myself, for my leadership team, for my overall team. And this came to me. So I was listening to Ed Milet, who, if you have not read the book One More, you should pick it up and read it over next week when it's a little bit quieter. So as if it hasn't been quiet already. So if it's a little bit quieter next week, Ed Milet, one book. So here's what he says. He talks about seeing it. If you want to dominate, you need to consistently see what you want. Our mind moves towards what we are most familiar with. If you're most familiar with what you stress about and what you worry about, well, that's what you're going to head towards. NASCAR racers are always told, never look at the wall. So as you're designing your 2023, I want to remind you, get super clear on casting an extremely strong vision and then spend time replaying that vision over and over and over in your head. And somehow coincidences start to happen that literally lay out your vision in front of you. Because if all you're doing right now is looking at the worry and the anxiety and the stress, well, guess what your 2023 is going to be? Instead, if you want to dominate, identify those things that make that happen and then focus on that. Megan, I hope you're off to a great start. I'm excited to hear what you've got to say this morning.
Yeah, it feels like the market just hit the brakes all of a sudden. And my broker count for title insurance went way down in this last week or so, but the market has really gone into a lurch and it's really preparing for the holiday season. And this happens every year where things get really quiet these last 2 weeks of the year. Now that week between Christmas and New Year's, expect there to be hardly anything going on because that is truly the slowest week of our year. And so I hope that you're able to take some time off and spend that time with family and friends and enjoy some of the holiday season. But I was out at the hockey game last night with some clients and I was asking them if they were done for the year. And they said, I've got one closing left and then I'm done for the year and I'm just going to take the rest of the time off. We were also talking a lot last week about if you've got a sale listing that's been on the market for a couple of months and you're not getting showing activity and you've gone through and done the price reductions, that now may be a good time to pull that listing from the market and let it sit in an off-market status for 30 days before you go ahead and relist that property. We'll talk a little bit about prime listing time headed into 2023. I'll go ahead and share my screen so that we can go over all of the data points for you for this last week. But again, it ended up getting really slow out there.
You gotta say it again. It happens every year.
It happens every year.
Slow down for 2 years. So this feels so weird.
It does feel weird. And so again, focusing in more on what's happened from 2013 through 2019, this is very common for us to see this complete lurch in the marketplace that happens during the last 2 weeks of the year. But this covers the week of December 14th through the 20th for pending transactions and what's been happening with those. Looking at all price ranges, again, looking into 2023, if you're going to pull your listing from the market, what I like to do is look at your target listing month across the top here in yellow. Your target closing month comes here in black. based off of the average days on market for that time and how long it takes to get from contract to closing. And looking at where the cells become most red, we really do see the best opportunity listing into March, April, and May of next year. April turns the most red. Now, again, looking into what's happening, we're watching for this purge of expired and withdrawn transactions. We've probably got about another 900 purge transactions to go for us to get back down to low levels headed into January and February, and that's likely to come at the end of December 31st. I will still be publishing a report next week, even though we won't be having our webinar, so you can keep an eye out for that. That goes over what happened over Christmas weekend. I'm not expecting big numbers to come up, but I'm expecting there to be big jumps in some withdrawns and expired transactions. This last week, again, you can see that we're pretty blue across the bottom. We're not as blue as we were back here over Thanksgiving week. And so the market has warmed up a little bit, and the odds of selling did actually go up this last week because people are pulling their listings from market. But we ended up with about 2 months worth of inventory headed into this last week. And so that was up from the 1.8 months of inventory that we saw last week. That was more of a demand side drop because we ended up seeing that about 13% fewer new listings went under contract this last week. Our average daily active count came down again by another 5.6%, and new listing activity was down by almost 30% this last week, with only 384 new listings coming back on the market. Now, I would not list a property going into this next week unless you absolutely have to for some reason. I don't expect there to be a lot of showing activity. I don't expect there to be a lot of traffic. Again, headed into this weekend being Christmas weekend, I'm not expecting there to be a ton of activity. But we ended up with about 5,411 average daily active units, which is pretty much where we're supposed to be for the month of December, based off of data from 2013 through 2019, excluding those pandemic years. Again, when I go through and put together my projections for next year, I'm looking at more closely 2013 through 2019, and I'm going to exclude 2020, 2021, and 2022 because those are outlier years based off of what's happened in our real estate market. We ended up seeing that expired listings increased by 18.3% and withdrawn transactions increased by about 0.5%. And so we are seeing more and more expired and withdrawn transactions that's driving our inventory down, but we're right about where we're supposed to be for the month of December. I kept getting past an article this last week that talked about how inventory was going up. And it's true that inventory is up from where we were 1 year ago, but is 1 year ago even a fair comparison? Because again, it was such an extreme year with interest rates in the twos that it created this surplus of demand. And so when we compare it just to last year, yes, we are way up, but when we compare it to 2013 through 2019, we're right on pace with where we're supposed to be, with about 5,500 average daily active units for attached and detached residential. So I'm calling it, this is really just our new normal market that we're getting back into. Looking at the odds of selling, they actually went up by almost a full percent this last week to 46.3% odds of selling. So if you list a home last week, you had about a 46.3% chance of getting it under contract in the first 30 days. It's way down from where we were earlier this year. Again, we peaked back over Super Bowl weekend where we hit about an 82% odds of selling. So we're down to 46.3%. And there's still a lot of uncertainty in the marketplace. That number is likely to go down as we go into next week and people really take time off for the holidays. It's probably going to drop down into the 30s. And so I don't expect there to be a great odds of selling as I publish the report for next week. The odds of selling, again, is where I take into account all of the available listings for sale versus those that go under contract and or close in that week. And I project it forward for a 4-week period of time. So again, that's your odds of selling. Looking at what's happened with our percent of balance, we're still only sitting at 32.9% of a balanced market. Based off of what went under contract last week, we would need to have about 16,500 average daily active units in order for us to get up to that 6-month supply of inventory. And that number is likely to go up next week. Again, with less units going under contract and more active inventory in the marketplace, we're going to trend more towards a balanced market next week. And so again, if you have a buyer that's been out there, this is a great time to take them out between Christmas and New Year's because the showing activity is going to be relatively dead. And so if you've got a client that's been out there and hunting, take them out over this next week. And I'm sure that you'll be able to have some great negotiating power on behalf of your clients because we're going to trend towards that balanced market and they'll have fewer people that they're competing against as they go out and look at showings. Showing totals came in this last week. They were down by 11.2% from the previous week. We said about 8,120 total showings this last week, and that was about 1.5 shows per property per week. So So again, pay really close attention to what's happening with your showings. I can always pull that showing report for you from Showing Time that talks about your zip code and your price range for how many shows per property per week you should be getting. This is a great report to look at. It's the target market analysis report in the upgraded Showing Time account, but you should be getting about 1.5 shows per property per week. So that could be strike one if you're trying to decide if you need a price reduction, is if you didn't get 1.5 showings on your property last week, it may be time to consider a price reduction. Conversely, looking at shows to go under contract, we're looking at about 13 showings to go under contract. And for the last 6 months or so, it's been hovering around 12 to 14 showings should yield you a contract. And so that number has been actually very consistent since about June that we've seen those numbers where it's been about 12 to 14 showings to go under contract. Next week, that number is likely to pop up a whole bunch because there will be fewer showings and fewer units going under contract. And so again, we're probably going to see that number jump next week where it's going to take more showings. But again, we'll see after the first of the year if we have our big spring pickup early this year or if it's going to take longer and it's going to be after Super Bowl weekend. But I don't think that the phone is going to be ringing off the hook right after the first of the year this year. I think it's going to take some time for our market to build up some steam. Looking at median days on market, we've been holding in there at 34 median days on market for the last 3 weeks in a row. So that number seems to have normalized and leveled out. It's up from the 4 median days on market that we enjoyed for the first 4 to 5 months of the year. And it's been slowly climbing ever since then. But now we're sitting about 34 median days on market. And so that could be your next to your third strike, is if you've been on the market for 34 days or longer, it may be time to consider a price reduction, but it's definitely taking longer to sell homes right now than it has in the past. And so I wouldn't recommend cutting your price after weeks number 2 or 3, but waiting maybe until a month after you've been on the market before you go through and cut that price. So don't cut your prices too soon. Based off of what went under contract last week, we actually saw price decreases come down by about 3%. And so we ended up seeing that it was 51.2% of everything that went under contract last week made a price reduction, with 47.8% making no price reductions whatsoever. The average price reduction also came down. It was only 7%, whereas last week it was about 8% of a price reduction, or about $45,000 off of the original price was what was getting it under contract. So price reductions have come down this last week. If you're looking to make a price reduction, I would not make it this weekend and I would not make it next weekend. I would wait until after the first of the year. If you're not going to pull your listing from the market, I would wait until after the first of the year to go through and make a price reduction when hopefully showing activity starts to pick back up again. The under $500,000 market, again, in 2023, April is looking really good for your target listing month. It's usually right after Super Bowl weekend that we start to see those listings pick up. And so if you've got one of those listings that might be on a busy street, has an awkward floor plan, has lime green walls, I would get it to market when inventory is shallowest back in February, right after Super Bowl weekend. If you've got a more cherry listing, maybe waiting until March or April to get it listed when the market really starts to pick up steam. Looking at our strategy sheets, our heat map for 2023, this last week, it ended up not being as blue as what we saw back over Thanksgiving weekend, but it was still blue, indicating that the market has cooled. We ended up seeing that our month supply of inventory actually came down to 1.2 months worth of inventory, which was a 3% decline from the previous week. And so we're only looking at about 1.2 homes per buyer available in the marketplace, with an average daily active count of about 1,600 total units. That came down this week by about 4.2%. New listings were down by about 30%. So we're not seeing a lot of new listing activity. Expect new listings to be way down next week. Back on markets were up ever so slightly by about 16.7%. Expireds increased by 13%. Withdrawals were actually down by 3.1%. Pending transaction activity only went down by 1.3%, which is why this month's supply of inventory ended up coming down this last week and tightening our market into a deeper seller's market for the under $500,000 segment. The odds of selling increased by 1.8%, so we're actually sitting at 57.1% for your odds of selling in the next 30-day period if you list right now. Again, I still wouldn't list a home under $500,000 the week between Christmas and New Year's, because again, the market just really slows down and everybody takes a break to spend that time with the holidays with the family. Looking at where we are in terms of balance, we only have 20.3% of a balanced market right now. In this market, we would need to have about 7,800 total homes available for sale for homes under $500,000. You should be averaging about 2.4 shows per property per week in this particular price range, with about 3,700 total showings that were set last week in this particular price bracket. 12 or 13 showings should yield you a contract. So if you've had 13 showings and no offers, that may be sign number 2 that you need to make a price reduction. Median days on market came down from 29 median days on market to 24 median days on market. So median days on market was a little bit faster, where it was just about 3 to 4 weeks on the market for a unit to go under contract. So that was the halfway point where half of the homes were under contract in 24 days or fewer. Only 46.5, only 46.5% of the homes reduced their price this last week for going under contract. And so fewer price reductions this last week by about 3.5%. People don't reduce your price going into this next weekend. Again, it won't yield you enough showings to make it really make a difference. The average price reduction was about 6.8%, or about $29,000, $30,000 off of the original asking price to go under contract. Looking at our strategy sheets for 500 to $1 million, this is really the bulk of our market right here. We weren't as blue as what we saw over Thanksgiving week, but it is slowing down out there, especially as we get closer to the holiday period. Our month supply of inventory actually went up this last week. We were up to 2.3 months worth of inventory. Sorry, I'm trying to move my window. It's blocking my numbers and I keep advancing my slides. Forgive me. So we went from 2.1 months worth of inventory up to 2.3 months worth of inventory. And you can see this blue line here. This is our active inventory, taking that nice steep dive that we need in order to kick off the spring market, in order to really get things under contract early in 2023. And so hopefully that continues to take a deeper dive and we see a bigger purge of expired and withdrawn transactions. But 2.3 months worth of inventory. So for every one buyer in the marketplace, they had about 2.3 homes to choose from. We have about 3,100 available homes for sale, and that came down by about 5.6% over this last week. Pending transactions, however, fell by 15.3%. So we put fewer new units under contract last week than what we did in the previous week. And that number is probably going to take a dive as we head into next week as well, with Christmas being over a holiday weekend and New Year's Eve. We really see that tank in the marketplace as we head into the last week of the year. Expireds were up by 22.6%, which was a good sign. We need to see those more of a purge of those expired and withdrawn transactions headed into the next week. The odds of selling did come up this last week to 42.7%, so that's encouraging to see. We ended up seeing that increased by about 0.6%, but it's down from 1 year ago by 36.8%. So again, it's not the same as what we used last year, which is why I'm going to be focusing in a lot closer on 2013 through 2019 and putting a lot of weight on what happened in 2019 in order to figure out what happened in our marketplace. We trended towards balance the most in this market. We're now sitting at 39.1% of a balanced market. Again, this is our most interest rate sensitive category. And so we end up seeing that a lot more people are sensitive to what's happening with interest rates, and they've been shook by what's happened with that. But hopefully with the conforming loan rates being bumped up to over $700,000 now, that helps them with having a smaller down payment. So they're able to get more home for less money down up front. But again, it was about a 40% of balance in this particular market. This is our most sensitive category. Looking at where we were for showings, that's about 1.2 shows per property per week in this particular market. We're looking at about 12 showings to go under contract. So if you're getting 1 showing a week and it's 12 showings to go under contract, you could be on the market for, looking at almost 3 months before you go under contract in this particular price point. We're looking at 37 median days on market for 500 to $1 million. That's come down from 41 where we were back over the week just following Thanksgiving week. So 37 median days on market could be cue number three that you need to make a price reduction. So I'd say wait a month before you make a price reduction on your properties to make sure that you're getting enough people through these homes. The number of units going under contract that made price decreases came down by about 4.4% this last week, with about 55.3% of homes reducing their price and 44.4% making no changes whatsoever to their price for price reductions. The average price reduction was about 6.9% off of the original price, or about $49,000 from the original price. We'll call that $50,000 for a price reduction for 500 to $1 million in order to get under contract. Looking at the $1.1 to $1.5 million price point, now we're only talking about 7.6% of our overall marketplace. Looking at timing in the market, March is the best time to list a property headed into the new year. And so I get those listings to market a little bit earlier than that stuff that's under $1 million. And so March really looks like prime time. You actually have your highest and best close to list price ratio as you get into April and January through February. So a little bit earlier for this market than what you're looking at for under $1 million. Here's our heat map for 2023. Again, you can see the cooling trend settling in where we have more blue cells. These cells over here turned red because there are fewer new listings and fewer back on markets that are coming back to market. And so again, listing when there's less competition out there can give you an advantage, but overall the buyer activity is really slowed. So I wouldn't recommend listing through the end of 2023. Looking at where we are for our month supply of inventory, we went from 1.9 months worth of inventory up to 3.3 months worth of inventory. So again, as we start to get closer to Christmas, this average daily active count comes down, but our pending transaction count really took a dive this last week. It was down by 45.8% from where we were just the week prior, where we had a 1.9 months worth of inventory. So again, there's a lot of opportunity right now to be a buyer in this market and have negotiating power for those sellers that really wanted to get under contract and sell their home before the end of the year. We're looking at about 3.3. So for every one buyer in the market, they have about 3.3 homes to choose from. Expired transactions were up 41.7%. Withdrawn transactions were up by 28.6%. Again, leading to this nice dive off of our active inventory, getting us back down to historically low levels as we head into 2023. The odds of selling declined this week. It was down to 37%. So if you put up a new listing this last week in the next 30-day period, you've got about a 37% chance of selling. We're looking at about 36.3% of balance. And so again, this number shot way up because our pending transaction count shot way down this last week. We would need to have about 1,000 units available for sale in order to be at a 6-month supply of inventory. We only had one show per property per week. Only 365 total showings were set for homes between $1 to $1.5 million. So showings are going to be way down for the next 2 weeks. Looking at where we are for shows to contract, it's about 14 showings to go under contract. So if you've had a total of 14 showings and no offers, it may be time to consider a price reduction. Median days on market shot up to 40.5. So if you've been on the market for 40.5 days or longer, it may be time to consider that price reduction. So we're looking at just over a month for half of the units to go under contract at this point. Last week, we ended up seeing that week over week, our price reductions increased by 13.7%. So it was 54.2% of what went under contract last week made a price reduction, with 41.7% making no price reduction. Average price reduction came down. We ended up seeing that it was about an 8.2% price reduction, or about $109,000 off of the original price to go under contract. Now for 1.5 to 2 million, we're only looking at 2.8% of our overall market. I can't trend anything over $2 million because there's just simply too few listings in that particular price band for me to really make a good analysis. Your target listing time for the 1.5 to $2 million mark also looks like March. So this market hits a little bit earlier. February looks pretty good as well. If you choose to list your home in February or March, that's probably going to be your prime time headed into 2023. Here's our heat map for 2023, and you can see the blue cooling trend as we see fewer new listings going under contract and fewer showings that are happening overall in the marketplace for the 1.5 to $2 million mark. Our predicted month supply of inventory popped up from 2.7 months worth of inventory last week to about 5.1 months worth of inventory. So for every one buyer in the market, they have about 5.1 homes to choose from right now. There's only one coming soon. I'm not expecting there to be a ton of new inventory coming on market next week. We only had 6 new listings this last week. Our average daily active count came down by 11.4%. We had 1 property come back on market, 7 expired, 9 withdrew, 7 were pending, which was a decline of 53.3% from where we were from where we were just last week. And we had 10 that closed in the last week. And so again, our month supply of inventory popped up to 5.1. I won't be surprised if that number pops way back up again as we head into the last week of the year, unless there's a big purge of expired and withdrawn transactions headed into next week. The odds of selling declined by about 4% this last week. We're now sitting at about a 28.5% chance of selling in the next 30-day period for the 1.5 to $2 million mark. If you just listed a property, we're now sitting at 42.4% of a balanced market. So this is our market that's closest to trending towards balance, and this market can bang around a whole bunch just because I'm only dealing with a handful of listings. So I mean, if a few listings go under contract versus a few listings not going under contract, this number moves around a whole bunch. But in this market, we would need to have about 365 total units available for sale in order to achieve a balanced market. We were looking at about one show per property per week in this particular market. So if you're not getting one showing a week, you may not be in your target zone for pricing. Showings to go under contract shot way up this last week to 22.4. That number has been hovering closer to 12 to 15 shows per property to go under contract for the last 6 months or so. So 22.4% is just a recognition that we're headed into the holiday season where people are maybe looking at more properties before going under contract. And we had one listing that was on the market for a really long time that finally went under contract that shot our median days on market up to 99.5. I won't be surprised if I see that number remain high going into next week, but that's just over 3 months to go under contract. And so again, you may need to consider a price reduction after 3 months of being on the market. That number has been hovering closer to about 50 to 60 for the last few weeks. So average days on market or median days on market is likely to remain high through the end of the year. We saw that 50% of homes that went under contract made a price reduction, with 50% making no change to their prices. We ended up seeing a 9.4% price reduction, which was down from the 12.3% price reduction that we were seeing last week. But that's about $191,000 off of their original asking price in order to go under contract. We have one question, and so let's talk about that. So the question is, before you wrap, what's the schedule for these briefings in January? I think we're on for every day. Did you have a couple of days that you were going to miss in January, Nicole? You're on mute.
Like that. Yes, I did have a week in January, and then we have a 1 week in February. And off the top of my head, I don't know what that is.
Okay, so we'll be doing most January, so we'll stick with Thursdays at 10 o'clock headed into next year, with the exception of one day where I think Nicole had some travel or she had a conflict, and so we'll be skipping 1 week, but the reports will still go out. I still put together the report each week, even if we don't have one of these briefings. That was our only question. Well, actually, another question popped back up. What was our max inventory at the peak of the Great Recession? So our max inventory at the peak of the Great Recession was actually before we went into the recession back in 2006. It was June of 2006. We had 36,000 active listings available for sale. Back during the recession, we actually ended up, it was closer to about 30,000 total units available for sale. And keep in mind that 52% of them were distressed transactions, being foreclosures, short sales, or HUD homes back in the peak of the market back in 2010.
You know, as I'm listening to you, and I was looking and seeing what was happening on a national level and with the economics and in planning. And as you had made mention, you know, that you were going to remove 2020 and 2021, and that you were going to go back into those previous years to determine what your volume expectations were for next year for title orders and for, of course, putting out your predictions for next year. Guys, we are going to hear a ton of analysis right now. We're going to hear economists who come out and predict what they think the economy is going to do. And I'm seeing everything from it's going to be an absolute disaster to, you know what, it's just going to look like 2019 or even better than that. So the spread by which somebody is determining what the Fed is going to do, what inflation is going to do, what the interest rates are going to do, when the buyers are going to come back, when those sellers are going to come back, how much of that inventory is going to come back. Listening to Megan, I just keep coming back to the fact of this is trending towards our new normal. And these numbers are actually right in line with what we saw pre-pandemic. We have to get out of fear, focusing in on what the lack thereof and focusing in on the abundance of 2019, which was a great year, 2017, 2018, 2019. Yes, there was a little bit of a fear when the interest rates popped up, but otherwise we had great transactional and supportive years to support our clients. So to get caught up in the noise, what your clients are seeing and you're seeing is misdirecting your focus on those things that won't bring you the kind of success that you want to see next year. So keep focusing on the messaging that Megan and I bring you every single week, especially as we roll into January and February, March, because I think that those 3 months we're still going to see a lot of shifting. I loved those, the heat maps as far as talking about where are we gauging at what price point, when to start showing listings, whether it's February or March or April, but that could change as we start showing what is January's doing and what the beginning of February is doing. Really watch the trend lines as it compares to previous years when Megan shows that, to best advise your buyers and your sellers. Because this is, my gosh, there is no other access point to the kind of information that we bring together every single week to help you kind of muddy through, or I should say, press through, right, the noise and the mud, and getting to what your clients really need to hear, which is just honest advice. It's not trying to make, I am blamed for being super positive all the time, and I get that. And sometimes you just got to tell the truth, and sometimes the truth isn't as positive as I want it to be. But I'm really thinking next year is going to be really fantastic if we stop getting in our own way. With that, Miss Megan, I'm going to share my screen, and we're going to go through some things that are happening in the economy. One quick question popped up. Megan Douglas, what is the best way to set up the right frame of reference for our clients as to why 2019 is the best comparison? Is it mostly focused on supply and demand statistics?
Well, that was the most recent year that I can measure where interest rates went from 3 to 4.5%. So I can measure the impact of higher interest rates and what that had. And 2018 was a sensational year, so we had kind of a wonky measurement. I expect there to be some negative appreciation as we head into the beginning part of 2023 because interest rates are higher, that we're not going to see those massive bidding wars just comparing 2022 to 2023 because we had such a sensational start to the beginning of 2022. And so 2019 was very similar in that sense when interest rates went higher, that we saw that dip in appreciation as we headed into the beginning part of 2023.
Yeah, and I was going to say something similar in the sense that we saw that interest rate spike at the end of 2018, which slowed down the market. And if you actually do a monthly graph, so I track all of my volume, and I have for all the years I've been doing this. And so we track it by month. And if I look at 2019, the volume's all stacked in the second half. Now there's healthy volume. It's not like the end of 2022 where it kind of came to a halt, but there's healthy volume, smaller volume in the first half of 2019 as we recovered from the little pop in interest rates. And then it gets stronger and stronger and stronger as the year progresses. And we were then heading into a recession before the 2020 pandemic. So the economy was still slowing down, yet housing was still strong. So if you look at it by month, I don't know if you track your sales by month, by year, but if you have something like that and you start to mirror over what 2019 was, and maybe even take the same number of units, because that's one of the expectations that MBA put out. They put out a forecast tracking right with 2019. 2018 was a little lower. And then every year all the way back to 2005 was lower still. So to have a 2019 parallel with slightly higher appreciation numbers, so don't take the 44% that we saw over the last 2 years. I'm using 24%. I'm using a 24% increase in loan amounts from 2019 and putting that over for our 2023 forecast. And of course, knowing that we're going to have that slower start in the first quarter. But that first quarter is going to be shifting. The second quarter, we should see the Fed stop and hold in the higher Fed rates, which is going to allow inflation to slow down, which is going to bring the 30-year fix down, which is going to allow those 31-year-olds to get back into the market. Remember, they were priced out for 2 years, then they were feared out for the last 6 months. They did not go away. They didn't move to Mexico and Canada. They stayed here. They just re-signed a lease and they want to get in. And so now when we see interest rates in the low fives with no points, they will gladly jump in, putting upward pressure on prices and putting stability. Now, not the kind of pressure that we saw in 2020, 2021, but we are going to see an upward pressure on prices that will hold it. Maybe we land at 2% or 1% appreciation for the year, but it will hold it right there, letting them get in and at that lower interest rate, which saves them a little bit on their monthly mortgage payment. Right, and then starts to stabilize the economy with the second half of the year being more of what we think of as a traditional real estate market. All right, no other questions. I'm gonna go ahead and share my screen. That was a long interlude. Okay, here we go. I just want to talk. So here's the deal. My office is closed today, and I usually go into the office and I have 15 other people that I get to hang out with, and I'm alone. And even Megan isn't with me today. So
I know, it's so weird. I was trying to remember how to set this all up when we're doing it remotely, and I was like, oh my gosh, am I doing this right? Like, I can't remember how I was supposed to get this set up when we're not together.
I know. I was like, I just want to keep talking. All right, here we go. So we're going to go run through these because there was some economics that happened this week, certainly not at the degree by which we saw last week. I mean, last week, the previous week, we had the CPI numbers. We had all kinds of really big things happening, especially with Powell, who came out. So let's just go through kind of the things that happened. And of course, the gift that keeps on giving. That's what I'm going to call it. So we always do kind of a little bit of a heads up on what's happening this week and next big thing. We decided that we kicked off a $75 off the tickets. And this is simply my Christmas present to you. I know that money is tight. It's not escaping me. I know that the commitment to go to an all-day event is a big decision. But I also know that the stacked speakers that we have, and we put on good events, you will walk away with so many great ideas that the idea of spending a couple $100 is second thoughts. Because this is the opportunity to really sharpen your saw for 2023. I mean, we've got speakers talking about things as far as gaining influence. Don't just talk to people, influence them. It's a shift that is going to blow your mind. That's coming up. How to get creative, how customer service. We're talking about social media and dominating that. All the things that you think you want to discuss, we're discussing. And look at, here's the deal. I'm bringing in speakers from the likes of Inman and NAR conferences, massive conferences, and we're bringing them to town. Literally, all you have to do is get dressed and drive downtown. I can't make it any easier. And I do want this to be, RE Colorado is one of our sponsors. They're going to take it to a higher level even next year. Super excited to be partnering with RE Colorado. So this is just the beginning of something really fun and big. All right, so let's go on with what's happening in the economy. And I want to make sure my Facebook is on too. All right, so we've been seeing some really light trading days, and that's going to move the market more than it typically should. So just ignore what's happening with the interest rates, with the bond market, with the stock market on times like this, because ultimately we actually saw an increase in interest rates, which I actually think, so tomorrow is the PCE, we might see all of that come back, or we might just see the lack of trading days, or I'm sorry, the lack of trading volume during the holidays kind of give us a non-starter. But we did see a nice little trend right before kind of everyone went on vacation. In fact, Lawrence Yun came out saying that the market may be thawing since mortgage rates had fallen for 5 straight weeks, which they had, dropping that average monthly mortgage payment $200 lower. Every little bit we saw it because we saw 5 straight weeks of mortgage purchase application data go up. So all of these things, like, is it time yet? Mom, are we there yet? Is it ready? Can I get in? Like, there are people that are taking advantage of this kind of market. If you have buyers and they're willing to go out, especially during this week between Christmas and New Year's, as Megan talked about, they're going to find the deals. They're going to negotiate hard. They're going to offer less than asking. They're going to ask for all the inspection items, and they're probably going to get it, especially if that seller's been on the market for a while. This is the time to just tickle some of those buyers that maybe have been slightly active, that says, this is the week. Otherwise, not a big deal. I'll see you after the holidays. And I got to go bake some cookies. Like, take some time off and don't get stressed about it. Don't focus on what you're stressed about. So just kind of highlighting, we did see after this nice drop due to one of the inflation reports, the last 5 weeks, really from the beginning of December, since we had seen that drop until these really light trading days, where we see things like Japan came out and surprised the market by raising their central bank rate. We had the ECB raise their central bank rate. Switzerland did it, a number of other countries. And interestingly enough, when these other countries are raising their Fed rate, here's a byproduct. they're not investing any longer in the United States bonds. And so when their own countries raise their central bank rate, they're investing in their central bank, and then they're not bringing more demand into our bond market, which is also hurting our interest rates. Just a really interesting side note on some of the things that are happening globally. All right, so initial jobless claims came out, and it's certainly something worth talking about because it didn't go up. It didn't go up nearly as much as we were hoping to see it. So initial jobless claims were estimated to go up 222,000. Instead, they went up 216. What I think is even a little worse news than that is the continued claims went down. So both of them were pretty flat, but that means the resiliency, right? The resiliency of the worker. They're continuing to find other jobs as soon as they get laid off, or they're coming off unemployment to find other jobs. So that's really good for you and your buyers because they have money, especially job changers, because they still get more increases in wages than job stayers. But still, it's not helping what is Powell's biggest focus, which is the wage inflation. That has been his #1 target in looking at wage inflation and housing data, bringing those down, which is going to have the biggest impact on inflation. So then is Powell fighting a losing battle? I mean, we have supply and demand issues of 1.7 jobs per every unemployed person. We have baby boomers who are starting to retire. And then we have this slow entry, or we have millennials, or especially the younger millennials, whether they're gigging it, whether they're becoming social influencers, whether they're becoming self-employed, those things where they're following their passion and they're not entering the workforce is just simply continuing to put a demand on those employers who are trying to find people to fill those open jobs. Now, of course, we've been watching, there's some tech companies and of course, real estate companies and some other companies that are starting to do layoffs, but it isn't impacting our unemployment numbers. Now we'll get that out, not this next week, but the week after that, the first Friday of every month, we get the unemployment numbers. Now, if that unemployment stays flat or even goes a little lower, we are going to expect Powell to come out saying, we're still not getting enough traction. We're still not hitting the things that we need to hit to slow down inflation. And remember, slowing down inflation is going to slow down the 30-year fixed or drop that interest rate. Now, having said that, regardless of what happens with the wages and what Powell decides to talk about on his stand, it might or might not actually change what our 30-year fixed is, because the overall core inflation is slowly coming down. Those inflationary numbers around shipping and around manufacturing and around production and around consumers is slowing down. All of the numbers show that it's reached the peak and it is still increasing, but at a slower pace that's dropping that year over year. Now it's happening so slow that it could take another year before we get anywhere near the Fed's target of 2%. In fact, it could be another year before we even get to 3, and then it might slowly trail off from there. So none of this is happening immediately or overnight. Rates aren't going to drop down to 5% or 4.875 overnight. But could we see that by February or March? We could, and then it could stay there. Now, I don't expect, nor do we ever want it to go down to the 2s and the 3s again. But could it hit the high 4s, the low 5s? Could that demand pick back up again? Could it put pressure on supply? Could those sellers actually get more money for their listings? Because supply is still going to be an issue going into next year. So consumer confidence also came up higher. You're like, what? So we're going at the end of the year, interest rates are up, my cost of borrowing is up, credit card interest rates are up, everything is up, yet consumer confidence rises. So 19% of those who were surveyed says that business is good. 48% said the jobs were plentiful. And 17% expected their incomes to increase. So those who were surveyed for the consumer confidence are still saying the employment scenario, remember, consumer confidence and consumer sentiment are two different things. Consumer confidence, we're looking at those job numbers, and we know that. We know that there are more jobs than there are people. Mortgage purchase applications hung on. Now, it didn't increase this last week. It was flat. It had a 0% change. Interestingly enough, though, mortgage applications as a whole went up because refinances went up, because we saw interest rates dropping over the last 5 weeks from 7.25% to 6.25%. So anybody who needed and was sitting on the sideline getting a divorce, needing to pull cash out, do debt consolidation, maybe they are worried about 2023 and going into a recession, and maybe even if my interest rate's a little bit lower, I've got to pull cash out of my house, lock it down at 6.25%, and pay off all of the high credit card debt, which that interest rate continues to go up. So refinances were up, mortgage purchase applications stayed flat. I would expect that that will continue through the end of the year, maybe even dropping a little bit as buyers are turning more towards their families instead of purchasing a home. GDP also came out with the third estimate this morning, and it's been going up. So remember, first quarter and second quarter were both negative, and there's a big conversation. Have we entered a recession? Is this not a recession? We had 2 consecutive quarters of GDP decline. This third quarter keeps getting stronger, even though the third quarter's over. Like, how does it get stronger if it's done? Well, it's all the metrics. They have 3 looks. It's the only metric where they actually go back and recalculate it 3 times. And based on inputs coming in, they're determining what the GDP is, the gross domestic product. Are we selling more? Are we producing more? Is our economy going up? And so it's been slowly increasing every time they measure that third quarter data. Again, just continued resilience, strength of the economy, talking about the fact that if we go into this recession, it's going to be relatively shallow and probably very short. It is simply trying to get that wage inflation under wraps. So everybody's waiting on the PCE. We know the CPI came out and it had dipped. The market moved a little bit. It liked it. The Fed still raised the Fed rate, the 50 bips. They expect to raise the Fed rate another 1.25%. And so everybody's waiting for the PCE, which is going to come out tomorrow. Now, the PCE could come out a full 0.5 point lower, which could or could not move the markets. So it's really hard to tell because it's not really any new data than the CPI already came out with, yet the PCE doesn't look at housing as strong. And if you remember, housing, in fact, housing was the number one or the only indicator in all of the factors that go into the CPI, where it was actually higher in November than it was previous months. Everything else had been slowing down. So the PCE, though, doesn't look at housing. So it could drop. The markets might really like that. There's not a lot of traders on. It might move the markets, and we might have one last hurrah with lower interest rates before the end of the year. We'll be sending out our Friday text. If you're not on the update text, we'll be sending out an email this afternoon with that text number. So letting you know if we're going to get a nice little run at the end of the year with lower interest rates. So if you do have somebody who's out there looking, who wants to take advantage of sellers who want to get out of the market, it might be a little last present to you from me. And if it's not good, then it's not from me. Okay, here we go. So, and we also know that housing has turned down. So that's not a surprise. So the fact that the CPI and the PCE are still seeing this majorly trailing housing indicator, we know that as soon as it catches up, that based on the reports that Realtor.com are showing, that NAR is showing, that we're seeing, that Megan is showing, all of the reports is showing those housing numbers coming down and those medians coming down. So we also saw the existing home sales came out this week. Now this is a little dated because it is November and we're talking about numbers here locally week over week. But of course the media is picking up on this. So just watching what is going out from a national level with NAR is good to know how it compares to our local numbers that Megan is showing you. So the existing home sales did come down. In fact, sales came way down, and it was down as far as it was during the pandemic. And then you've got to go all the way back to January 2011. And this is an annualized number based on the sales in November. So that came down, and it's not unexpected. And so did the prices. So that dropped. NAR's number through November dropped it the month before. It was right here. And so those appreciation numbers are not negative, but it did come down to below 5% annualized year over year growth in prices, in median home prices. And in Denver, we're seeing the same thing. In fact, we've slowly started to head right back to where we ended at the end of 2021. So our end of 2022 is going to be very close. In fact, it's only 2% higher based on the median sales prices, based on the data that is collected by Realtor.com, is showing that this number is very close. Again, not negative, normalizing, slowing down, higher interest rates, demand pulling back, inventory now pulling off the market, heading into 2023, which is going to be a reset year where we're going to see that first quarter when people are trying to figure it out, the second quarter where interest rates are going to drop, where we're going to see more demand come in and start to normalize the second half of the year. All of that is not awful news. It's just news. It just is the statistics and the data that's being presented as we're seeing us finally coming off of the sugar high that we've been on for the last 2 years. So Black Knight actually came out saying what might feel like a housing crash to anyone who entered the market at or near its peak in the past year is simply a correction. It is no longer a seller's market. It is no longer a market where sellers can expect auction-like bidding to push offers over list prices. Homes listed for sale will now require more time on the market. The pool of buyers have been dramatically reduced by mortgage rate increases. The slower market is not atypical, but rather a return to the normal. In fact, they put together a chart that I knew Megan would love. I found it just for her. So they put
Any
together
graph that looks like a Dr. Seuss graph, I just love. I love area graphs.
I'm like, oh, I'm so including this. So Black Knight put together their transition report saying, where are we seeing more of a normalized market? And they're doing this based on sales, days on market, months of inventory. So all of these kind of metrics go into it. A total of 10 metrics go into this. And so this blue area of hot is slowly dissipating. Yet the distressed is staying flat. We're simply creating more normal. In fact, there's not even weak really coming back into the market yet, because I know there's going to be forecasts going into next year talking about Denver specifically, because it's on one of the hottest metros that we saw this amazing growth, which we did. We saw 44% increases. We're going to see some of that be taken back. And as different people want to determine how much of that we're going to have to give back, overall, our metro is more normalizing than seeing distress or even getting weak. Yet, affordability is obviously still a concern. But 40 to 70 is the range where you see more markets entering into a normalized range. And we're almost there. We're just under 40% right now. In fact, if we look across the country, Black Knight again put out this report. It was just released this week. You look around the country, this is November 2021. If I zoom in on Colorado, it's all hot, it's all strong. Very outskirts is good, which is purple. And then if I go into 2022, the entire country starts to head back towards good. Right? And if I zoom in on Colorado, then it's all, there's no red in here. It's not soft. Our market is normalizing. So heading back into those conversations where we can pull out the average statistics in 2013 to 2019 and look at what we're expecting for this next year. It's just zeroing in on those conversations when people want to send you the articles around how we're going to have a crash still, how the market is unsustainable, how there's no demand, how those listings are going to continue to sit on the market. Builder confidence also came out this week, and that was a little scary. So it actually came down even further for the 12th consecutive month. Builders are not loving these higher interest rates, as you can imagine. So as soon as those interest rates turn around, builders are going to start planning for that. If you're a real estate agent and you're working with builders, now is the time, especially if they have any inventory that's sitting on the market, to be getting creative on temporary buy downs, permanent buy downs, or the forward commitments that we offer. Getting creative with builders where if they can lock in somebody in the high 4s with a permanent rate buy down, it can offer those buyers the opportunity to lock in right now, maybe with a little bit of a discount on the price, definitely a big discount on the interest rate, and getting in before that demand comes back in. Permits also hit a 29-month low. That just came out this week as well, which goes into inventory. If we have the builder's confidence, which is low, and we have permits slowing down, and we know that a lot of people are going to lock in those homes, they're either going to convert them to investments or they're just going to stay put. I shared that survey from Bank of America last week where the Gen Xers and baby boomers are 70%. They own 70% of the owner occupied homes today. And if they own 70% and 70% of them are planning on retiring and staying in the home that they currently live in, and then you have everybody who's going to hold on to that home who is going to move, but hold on to it as an investment. And then you have builder confidence, which is down, and you have starts, which is down. We have to know inventory is going to turn into a big conversation next year, especially the second half of the year. So if you can lay this out for your buyers and talk about the opportunities that right now through probably April is going to give them, then you know you're doing your best to serve your clients. They might or might not be ready to listen to that, but knowing that you serve your clients the best is giving them the advantage to get into a market where they can still save 50,000, 100,000 over listing it or under asking, sorry. They can still save all those inspections and they get in. And when we see that appreciation pick back up again, which it always does, historically homes always go up in value. So, they continue to go on that if I look at this months of inventory, I mean, it feels like a lot, but historically we're still so low. Yes, demand came down and inventory is starting to come down, but here's some good news. So gas is actually lower than it was last year. I got to end this on good news because come on, that's just how I roll. So gas is lower than it was last year. We're seeing that celebration. When I talked about the consumer confidence index, some of that was rolled in, lower prices. People are feeling it at the gas pumps. We're also feeling it builders, or if you're going to build, we're seeing lumber is down. If you're remodeling, if you're adding on, if you're one of the 70% of the 70% and you're going to stay there, you're going to be benefited by lumber coming down, and then savings accounts are up. I mean, come on. If there's nothing else about the Fed raising the Fed rate, that's the ticket right there. By seeing, you don't even have to lock it up into CDs to get interest rates in the 4s right now. We also sent out a Wednesday email about the DSCR loans. So talk about more good news. If you have self-employed people who might not have had the income, but still want to purchase because they have the down payment, and they have 25% down, then we use the market rents to qualify them. You need no income. You could be in the marijuana business. You could be self-employed and you write off everything. You could be retired and you don't have any income, and you can still purchase an investment property with a DSCR loan with no income documentation. We're talking to a lot of clients about that. You want to talk about some good news? That's really good news. And then, of course, make sure to not only get the tickets to the DMARS Economic Summit, our next big thing, and all the events that Megan and I are putting together to make sure that strategically we're supporting your best 2023.
Awesome. Thanks for that wrap up, Nicole. We do have one question from Susan. Is the 2% inflation target even realistic with full employment and rising wages?
It's going to be tough. And at some point, because remember, was it in 2021 when Powell came out saying that we were looking for an average of 2, that they were no longer even looking for 2? So at some point, if we still don't have the employees to fill those job spots, they might raise that 2%. But as of right now, they have been asked and answered. They are not changing that target.
Interesting.
Yeah.
Well, thank you so much, Nicole. And thank you so much for tuning in, guys. We'll wrap it up a couple minutes early. It was kind of, oh, wait, a couple more questions just popped up. I don't want to wrap up too much. Oh, just some thank yous. So you're welcome. What is the interest rate on the investment loan you mentioned with 25% down?
So the DSCR is going to be, it's based on how much you're putting down. If you're starting at 25%, and then what kind of property is it? Is it a single family? Is it a multi-unit? And then what is that rent rate compared to the mortgage payment? So there is a lot of factors, including your credit score. So we still pull credit, and we're going to be based on your credit score. It is going to be higher than a traditional investment loan, but it does not require the income. So it gets you in, and then you can refinance later. As far as exactly what it is, there's too many variables, but do know that it's at least a point higher, if not a little bit more, than the traditional investment interest rates. Although I have to say really quickly, we have incredibly low portfolio investment loan options. So if you have not talked to me about that, we need to discuss.
Yes. Do you want to give them your phone number real quick so that they can reach out to you?
I do. Just call me because I'm at home and I want to talk to people. So my My number is 303-808-2300. I mean, we're still locking in the sixes and the low sixes on investment properties with a couple of points. So depending on where the number is between 1 and 2 to get into the high fives and the low sixes is absolutely an advantage that you want to talk about. And the DSR. Yeah.
Awesome. Well, thanks so much, guys, for tuning in this week. We are wrapping it up right at 11 o'clock today. We're taking next week off, but the reports will still go out. So keep an eye out for those. They'll come out Thursday around 11:30 in the morning. So I'll still be putting those reports together for you. I'll be sending out today's reports here shortly as soon as I get a copy of the recording so that I can send you guys a copy of the recording. So if you wanted to rewatch this or share it with anyone, you're certainly welcome to do that. And so we will be back at it again starting in January of 2023 with our Thursday updates at 10 o'clock in the morning. So be sure to watch out for those emails so that you guys can get registered. We had over 1,200 people register for today's session. So thank you to those of you who joined us and watched us on Facebook Live. We hope that you have a very happy holidays and we will see you guys next year. Take care.
Absolutely.